Happy New Year, everybody, and welcome to the Lend Academy podcast, episode number 181. This is your host, Peter Renton, founder of Lend Academy and co-founder of Lend It Fintech. Today's podcast is sponsored by Experian's Clarity Services. They are the leading subprime consumer credit reporting agency, providing innovative risk management solutions to address the full consumer credit lifecycle. Clarity leverages the combined power of the largest and most comprehensive alternative credit data source with traditional bureau data to provide a more complete view of a consumer's financial behavior. Clarity is committed to providing products that address rapidly changing market conditions. You can learn more by visiting clarityservices.com/solutions. Today on the show, I am delighted to welcome James Garvey. He is the CEO and co-founder of Self-Lender. Now, Self-Lender is a fascinating company. They are doing something really unique in the lending space insofar as they've created a product that helps people with no credit score or a poor credit score, helps them build their credit fairly quickly and fairly painlessly. And they do this through a unique product that they've partnered with a bank to produce. We go into the mechanics of this in some detail. We also go into really who their target market is and the needs of this market. We talk about how they're able to find customers. We talk about the stats behind the increases in the credit score from their customer base. We talk about the future products that they are going to come out with, and we talk about what the future holds. It was a fascinating interview. Hope you enjoy the show. Welcome to the podcast, James.
Great to be here, Peter.
Okay, so I like to get these things started by giving the listeners a little bit of context and a little bit of background about yourself and what you did before you started Self-Lender.
Yeah, so I'm a software engineer by trade, and I spent most of my career working in online direct marketing. I've had two companies that I've started and co-founded and then ended up selling, and both help large companies send email at scale. And so, I come from this space from a totally different angle.
Mm-hmm. Interesting. So then, what was the idea? What was the germination of Self-Lender?
So I got married, and my wife and I, we decided to take a couple months off, and we're in Argentina, and I thought I set up my credit card on auto pay. 2 months into my billing cycle, I realized that I made a mistake and wasn't set up on auto pay, and I really hurt my credit score. And I was trying to understand how does credit really work? How does it actually work in the U.S.? And I'm not from a financial services background, so I just started digging in, doing research, and the more I read, the more I realized that I know nothing about payments or credit bureaus or anything. And that's when I discovered there's so many people that either don't have a credit score or have a low credit score. So I'm trying to understand, how do people solve this problem today? And what I find out is secured credit cards are typically the way that somebody's going to solve that problem if they can't get approved for a normal credit card. So you go to a big bank and you deposit $500, and they give you a credit card that's being secured by the money. And the challenge is, number one, you have to have that $500, which is a hard problem for a lot of people to have. And number two, if you need that money back, then you have to close down the credit card. And so it's a complicated problem, and there's really not a lot of good solutions for building credit for people that are either new to credit or for people that are rebuilding. And so I saw some credit unions doing something interesting. And some of the credit unions that I looked at are, you walk in the credit union, you make a $500 deposit, they then make you a $500 loan that's backed by the deposit. Now, that's not going to solve the first challenge of coming up with the money, but it does solve the problem of, okay, well, you've got these installments, you have a start date, you have a stop date, you have these equal payments. It makes sense, but the problem with that model is you have to have the money. And so the idea for Self-Lender was, well, what if I could partner with a bank and basically make you a loan where you have to put the money into a brand new CD? So it's basically like a small, $500 loan, where 12-month installment loan at roughly 10 to 12% interest, where that money goes into a $500 12-month CD that pays you, a tenth of a percent of interest. So the idea is that, we're lending you money, you have to save it. And the beautiful thing is, there's a start date, there's a stop date, you've got the equal payments, and it feels really like a savings plan that builds credit, and not like a CD secured installment loan, which is really difficult to say.
Right. No, I get it. So let's just dig into the process there for a second. So someone comes along to Self Lender's website, and I see, it says build credit while you save, and you get started, and you basically choose how much and whatever. So you said you create like a CD, a savings product. So someone says let's just take that example. So the $500 example you just gave, what do you actually do? That the money is deposited with a bank account before anything else happens, or tell us about the sequence of events?
Yeah. So what happens is behind the scenes, we have a couple of bank partners, and the action is, number one, we're going to lend you, $500 as a 12-month installment loan. And that the lender is our bank partner. They're the true lender. And then the money of the loan proceeds are immediately deposited into a freshly created FDIC insured CD that's in the customer's name. And so in the loan documents, there's truth in lending and truth in savings. It's from our bank partner to the customer. And so Self Lender is the technology arm. Self Lender is a servicer. And we are also the system of record. So we're the behind the scenes. There isn't the fight server behind the scenes. We actually built our own core processor.
Mm-hmm. Okay. Wow. Okay. So someone comes along. The $500 is the bank loans them the money, but they don't send them the money. They open up a CD in their name, and so then exactly. the person is paying back monthly. Are they paying back the bank monthly? How does that work?
Yeah, that's right. So what's happening is the customer is making payments on a fixed schedule that they agree upon when they get started, and those payments are being serviced by Self Lender. So Self Lender behind the scenes, we are creating the Nacho file that gets uploaded to the Federal Reserve. We don't move the money, but we do move the data, and so the money is being pulled from the customer's account, either through ACH or through debit card. And then what happens is, as the customer, repays the loan, they're paying down the loan, but yet the CD is slightly growing over time. And so at the end, the customer has paid off the entire loan, and then simultaneously the CD unlocks, and then the customer gets the money either via ACH or through check. Okay.
So and at the end of the loan term, there's no is there a rollover, or does everybody choose to take the money back? What happens after the period's over?
So when we first got started, we created this experience to really have a start date and a stop date, and it really is like, you pay it off, you get the money, end of story.
Okay.
That's how it is today, and it's not a great experience that way. And so that's going to be changing in the future. But as of today, you get the money, congratulations, your credit score is probably up, and we give the customer their credit score on a monthly basis, so we can actually track that over time. So they are getting some education and stuff, but they're not getting any other financial products other than our flagship product.
Okay. And so I'm curious. You said you've got a couple of bank partners. I imagine this is a somewhat of a creative problem, a creative idea that. It's not like everyone else is doing this. You're the first one that I've seen that has this approach. So how did those conversations go, and how are you able to get those banks on board?
Yeah, I'll tell you, it was really hard. So when I got started, I met with 60 banks.
60
and
60.
60. Yeah, 60. And it was really tough. Because if you don't speak the language that they want to hear, nobody's going to take you seriously. And so, when we first got started, I found a tiny bank based in Austin, Texas, that was willing to work with us. And so what I did was my wife and I, we from San Francisco to Austin so we could be physically close to the bank as we're building everything out. And it was incredibly valuable for us. And it would have been a lot harder if we hadn't done that. So, once you get your first bank partner, it's a lot easier to get the second and third and fourth and so on. But, the first one was extremely tough. And, in our case, as you said, like there's no capital at risk here, but you do have, operational risk, strategic risk, compliance risk, reputational risk, it keeps going on and on. So, one of the things that we did early on, which is kind of rare for most startups, is, we became SSA 16, SOC 1 compliance. It used to be called SAS 70. And it's a set of controls that just allows you to prove to third parties that, you do what you say you're going to do. Yes, you have encryption. Yes, you do employee background checks. You have a written process and procedure for things, that kind of thing. And that was really helpful as we were getting started. So if we hadn't done that, I think it'd be really tough.
Right. Okay. So then let's talk about the customers that come to you. And I know you've started to get some traction, and I'm curious to know, like, who are these people? Are these all millennials? Are they immigrants? I mean, I presume many of them either have no credit score or obviously have a low credit score. But tell us a little bit about more about the people who are coming.
Yeah. So, today, most of our customers are people that are rebuilding. Only, a fraction of them are people that are establishing credit for the first time. And, we have customers in all 50 states. We have concentration around, the normal states that you would expect. And what we've seen is about, 70% of our customers are typically, below 35. So we have a lot of younger people that, have either established credit or are trying to rebuild with SelfLender. And what we've also seen, which is kind of interesting, is based on some of the Facebook data that we have, we're estimating 70% of our customers are women. And, we have a lot of customers that are African American and Latino backgrounds as well. So it's a really fascinating customer mix. And what's great about what we're doing is, we didn't have a chief marketing officer. We didn't have a marketing team until about 6 months ago. So, we've just naturally been able to attract a really great pool of customers that are, all over the U.S. And the thing that's fascinating is, our customers, they are, most of them at least, are not prime customers, but they don't have a subprime mindset. They're coming to SelfLender, they're making their payments, and, they're doing this in order to, build credit and save money, which is kind of an interesting thing, because you have to imagine there's some self-selection going on here.
Right. Yeah, I was thinking that, because if the mere fact that they've landed on your website means that they're interested in building their credit score, that they're not just a random person who may or may not care about their credit score.
Exactly.
Yeah. So then on that, then do you, I presume you say you do like AML and anti-fraud checks and what have you, but can anyone sign up? Do you do any underwriting on the individuals who are signing up?
Yeah. So prior to the customer being able to apply, they have to go through the normal knowledge-based authentication, asking some questions about their out wallet and KYC, AML, that kind of thing. But after that, you have to be 18. You have to have a social security number, which means you're either a citizen, a U.S. resident, or a non-resident alien. And the one piece of underwriting we do, though, is our bank partners have wanted to do check systems. And so the check systems underwriting that we do is, have you committed fraud, basically? Have you been reported as committing fraud? So, it's a very low percentage of people that are rejected. So, the very, very vast majority of applications are approved.
It's good to hear. One of the first people I've had on here that has that can say that, because obviously most lenders reject a large percentage. So then you said you've only just been marketing for 6 months or so, but how have you been finding these customers? I mean, have you just relied on word of mouth and PR? I mean, tell us a little bit about the strategy to build your customer base.
Yeah, so we've relied mostly on word of mouth. So, we do all of our customer service in-house. We track Net Promoter Score on a very, very regular basis. And, typically our Net Promoter Score on a weekly basis is in the 75 range. So it's really high. Mm-hmm. And, that's a Net Promoter Score of between negative 100 to positive 100, just to clarify. But, the customers have been really good at telling their friends about it. And, primarily because, if you're trying to build credit and, you get rejected, it sucks. And there's not that many options out there. And I think that's why the word of mouth has been so popular.
Mm-hmm. But you wouldn't get repeat customers, right? You said most people like they take their money. I mean, are they going to go? Do you get many people going through the whole thing again?
Yeah, we have some. The repeat rate is not very high, and it's about 15%. So it's something that we understand this is a problem with our model, because we have to be able to graduate the customer into another product, something that can keep them longer term. So yeah. Right.
Okay. So then what stats can you provide about how much is this actually really making a difference? What is say it's a 12-month term and the person comes in with, I don't know, like a 500 credit score. How much difference do you make? What do they end up at the end of the 12 months with?
Yeah. So the one thing I want to say first is that the data is reported as it happens. And so when a customer stops paying, as an example, the payments are being reported to the credit bureaus as delinquent. And so we do have customers that are delinquent, as well as people that are paying on time. And so when customers are paying on time and they're paying their other bills on time, and the way we're able to do that is, we give our customers credit monitoring for free. Right. So when there's new delinquency, new bankruptcy, new public record, we're able to track that. And so that's one of the reasons why we can say, well, if you use Self-Lender and you pay Self-Lender on time and you pay your other bills on time, we're seeing an average impact of 0 to 670 if you're starting from no score. If you're starting from a low score, we've seen about a 45-point improvement, and that's typically in the 6 to 12 month time frame. But just to say it out loud, I'm telling you this on your podcast, but you can look on our website, and we don't market it that way because there's some compliance challenges in doing that.
Sure.
We don't want to be deceptive, but at the end of the day, if you pay your bills on time and you're paying the bill that is reported to the credit bureaus, well, you're probably going to have a better credit score at some point. It's a pretty simple concept there.
Right. So then, can you share? I mean, it's interesting to me that people would be delinquent because they've got cash waiting for them at the end of the the cycle. So, could you share what sort of percentage that you're getting that are delinquent?
Yeah, it's about 7%.
Okay.
So it's not super high, but one of the things we do is we have auto pay. You can make your payments anytime. You can make one-time payments. And so we do have about 60 notifications that happen over the customer's lifetime. But, you're at scale, you're going to have people that sign up and they make mistakes. It happens.
Sure, I know, and actually that's lower than I expected it would be, to be honest. Because when you're dealing with the population, if they were taking out, from some of the subprime lenders, that they have delinquency rates in the 20s, 25%, or even more in some instances. So yeah, they're clearly. I mean, that's really more of a not a prime consumer delinquency, but like a mid-prime, near-prime consumer. I think that's not a bad effort, really. So then, what's your business model? How are you actually making money?
Yeah, so the way we're making money is, firstly, we had to raise a bunch of venture capital so that we can build all this tech behind the scenes. Mm-hmm. Most banks are paying their software vendors about $100 a year in software to originate and service a checking account. Just from the software standpoint, not the marketing. And that's really expensive. And it's like, well, if you're a bank, you'd rather have one customer with $1 million than $1,000 any day. So we built our own tech underneath that originates and services these CD secured loans. And, our cost to service them is extremely low. And our business model is pretty simple. These CD secured loans on the loan side, it's about a 10 to 12% interest rate. And what we do is, we work with our bank partners and we do a revenue share. And so what that means is the customer has to actually pay for us to make money and for our bank to make money. So it's kind of a cool, fair arrangement where, we all win. The customer wins, bank wins, self-lender wins.
Interesting. Okay. So then I'm curious about one thing. I read an article about you guys recently that talked about you're going to be launching a credit card in 2019. So it's obviously seems to be it's a natural product, I guess, but also is one that is fraught with more challenges. So tell us a little bit about what you're planning there and how that's going to work.
Yeah. So what we're going to launch is a credit card that's being secured by part of the customer's deposit. So basically, you join Self-Lender and, after say 6 months, you've been paying $50 a month and, your CD is worth, $500, but your loan balance is about half of that. And so you've got at least $250 of equity in your account is the way to think about it. And so the cool thing about what we're doing is we can give the customer a credit card where the credit limit is being secured by a piece of their collateral. And so it's a natural graduation that, the customer wants. They've asked for it, and it gives them some access to real liquidity that's in their hands that they can use. And we also have this relationship with the customer such that they have now a revolving relationship with us. And if we do it right, we can keep the customer engaged for the next decade. Now, there are limits on this. Of course, it is a secured credit card, but once we've built a pretty robust secured credit card program, we will just have to raise more capital, bring in some super intelligent people to help us on that side of the business. But, we can build a big business even without unsecured credit. And that's what we're really excited about. Our customers, many of them are not going to be able to be eligible for an unsecured credit card within the first year. And so they are eligible for this product. And that's really why we're graduating them into secured credit cards.
Okay, so in that situation too, I can see that they're making their payments on their self-lender loan, and their equity is increasing each time, so their credit limit could potentially increase. And so I guess then at the end of the 12 months or the 6 months, or whatever it is, at the end of the time period where they would typically get back that money, is that being held then at the bank, and they say, right, you did $500, now you've paid that all back, but that you've got your credit card, you've got a $500 credit limit. I mean, just tell me a little bit about what are the plans for post, once they've finished up their term.
Yeah, so we're using all the same tech behind the scenes, and it gives us the ability to say, okay, we're going to do a secured credit card that has a minimum $100 line of credit. So if the customer wants to reduce that credit line, they can, and still keep the card open. So that's one of the cool features that our card has. And so that flexibility is what our customers have asked for. And, we think that's going to be like the really cool feature that they want. But, it's going to take us years to be able to figure out, okay, well, how do you take those secured cards and turn them into unsecured? It's very much a lot more complicated than what we're doing today because there's no credit risk.
Right. Yeah. So they can take a portion of the money back and keep a portion that will then be used, so they can have a line of credit.
That's right.
Okay. So then I'm curious. One other thing I read recently about you guys, it might have even been in that same article, was around CRA. the Community Reinvestment Act, and how banks are always, banks have requirements where they have to be CRA compliant. They have to be loaning money to underprivileged or parts of society that are not very well served. And it seems like you have a core customer base that's really that what falls, I would imagine, completely within those kind of that community. So
that's right.
I hear you're talking with banks about this. I mean, how are you going to sort of use your unique community, because you have probably a very unique customer base in many ways? How are you going to use that to help banks meet their CRA requirements?
Yeah, and this is the thing that's interesting. So our customers are low to moderate income. They are absolutely the kind of customers that will qualify for CRA credit. The challenge for banks, though, is many banks have a very small serviceable geographic region, and I think that's one of the reasons why the CRA, the people in Congress are talking about, or at least American Banker, or they're talking about reforming CRA. I think it'd be great if it could have a much larger distribution, but our customers are exactly right. You hit the nail on the head here. These are people that are underserved, people that are low to moderate income, and should absolutely be able to qualify for that. Now, we've worked with one bank in a very small area to give them some data reports that we presumed were uploaded to the regulators for CRA. We haven't heard back on the status of that, but we assume that they should be able to get the credit. At the end of the day, though, the regulators have a lot of discretion on how that stuff's administered. So, we hope that there's going to be some exciting changes in the CRA in 2019, and hopefully we can play a small part in that.
Yeah, no, I think it seems to me everyone agrees that that this was written. The CRA was written in the 70s. Didn't even imagine the internet would exist.
Correct.
And so it really it's in desperate need of updating. And I think there's general agreement that should be updated. It's just how exactly it's going to be updated. That's going to be interesting. But yeah, we'll wait and see on that. Anyway, we're almost out of time, but I wanted to get a couple more questions in here, and I'm curious about the scale you're at. You've got firstly, when did you write your first self-lender loan, and then and how many have you done? What scale you're at today?
Yeah, so the first one was about 3 years ago, and I'll just put a caveat, was that for the first year of the business, we only did about 1,000 customers. We were trying to make sure that everything is correct, and when you're computing interest, when you're computing fees, when you're responsible for a lot of the stuff behind the scenes that we've been talking about, banks want to be confident that we are doing what we say we're doing. So we are doing today about, I'll just say, in 2018, we've originated over $100 million of CD secured loans. And we're doing about $500,000 a day of new originations. And so our expectation is that in 2019, we will at least double that number. So it'll be about 200 to 250. So in total, though, we've originated about $150 million.
Okay. So that equates then to well into the six figures as far as number of customers, I imagine, right?
Yep, about 200,000 customers.
200,000. Okay, cool.
Yep.
Okay, so then we've touched on this, and this is my last question. We've touched on it to some extent, but there's a lot of ways you can take this. But I'm very curious to get what is your vision like for the future of Self-Lender? Where do you want to be in 10 years' time?
Yeah. So Capital One got started doing secured credit cards, and what I want for Self-Lender is to become the on-ramp for responsible credit. We want to be able to be the biggest player and just affordable credit that's for people that are everyday Americans. We're not going to serve the best customers in the market. We're not going to serve the worst. We're going to serve just middle-class Americans that just need affordable, responsible credit. And 10 years, we're going to have a company that's got a lot of customers, and hopefully we'll IPO at some point. That's my boyhood dream. So we'll see.
Okay. On that note, we'll leave it there. Good luck with that, James. It's certainly a noble cause that you have there. And I wish you all the best. Thanks for coming on the show.
Thanks, Peter.
Okay. See ya.
Bye-bye.
What I love about Self-Lender is that they solve the catch-22 that many people starting out struggle with, where, to be able to obtain credit, you need decent credit, and you can't, it's a chicken and egg problem. Whereas what Self-Lender does, they solve that directly, and they solve it in a way that's creative and that really helps the consumer. It's really a win-win for everybody involved. And I think whether they get national scale like James hopes, I really don't know. But what I do know is that services like this are desperately needed. We need people to be able to get started in a responsible way, or rebuild their credit in a responsible way. And I think the service that the Self-Lender provides really does help do that, and it does a lot to help promote financial inclusion in this country. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's episode was sponsored by Experian's Clarity Services. Clarity's suite of FCRA-regulated reports and predictive scores yields significant insight into a consumer's financial behaviour throughout the alternative financial services industry. Clarity delivers data-driven risk management solutions that address prospecting, credit evaluation, fraud detection, portfolio management, and collections. You can learn more by visiting clarityservices.com/solutions.